Let's first also get a sense on the economy and what are the various projections that are really coming in for the global economy and how is India really placed amidst all of this. Who else to talk about this? A big voice when it comes to global economy, the one who also remember had projected the 2008 financial crash. Let me welcome on the show Jim Walker, who's the chief economist of Aletheia Capital. Jim, always a pleasure to welcome you on NDTV Profit. My first question, as we gear up for the new year, what are you seeing in terms of the global economic factors and what are your estimates when it comes to the large economies?
Yeah, well, I'm afraid, Nisha, the outlook for 2026 in our view isn't very good. We're expecting a significant slowdown, particularly in the United States, but also in Europe and the UK, as well as Japan. So, all of the advanced economies, in our view, are going to be slowing in 2026, which probably means interest rate cuts from central banks, which might be taken as a positive by markets. But I'm not 100% sure that the markets, in terms of bond yields, are going to be following the central bank cuts, because I think inflation remains a problem even as economies slow. But our outlook is, I'm afraid, for slowing growth. And that means that emerging markets like India and China really have to do the business themselves and get the domestic economies moving and stimulated.
So you are saying that there will be some bit of slowdown coming in when it comes to the GDP growth in especially the advanced countries, advanced economies. So Jim, what are the important signs that we must watch out for as the beginning of the slowdown, and what's on your radar for the next year then?
Yeah, well, the key thing to be watching, Nisha, is the investment component in the United States numbers, basically their GDP numbers. We had a recent reading from the United States, which, when I say it was recent, was actually referring to the third quarter, which finished in September. But of course, with the government shutdown, it was delayed. But that came in at a very strong 4.8% annualized growth rate. And people look at that headline number and think that everything is pretty good, except that that was really down to weak imports, which is actually an indication that the economy is not doing very well, and the consumer continuing to run relatively strongly, not just the consumer in terms of private consumption, but government consumption. But when you get to the investment side, as I say, that really is the key to every economy. The investment side in the US was flat. It was flat in terms of quarter on quarter annualized, and it was only up about 1% year on year. And then when you get through into the components of investment, what you find is that if you strip out information processing, in other words, the semiconductor boom that's been going on around the hype of artificial intelligence and hyperscalers and data centers, when you strip out the component that is being driven there, then the investment picture in the United States was actually contraction. And I'm afraid that's what's facing us going forward into the fourth quarter and then into 2026. And one of the things that we've been looking at as a company is the AI, I suppose the data centers around about the AI boom in the United States, which is part of that investment spending just now. And we feel that they're about to hit a brick wall when it comes to the availability of electricity to complete those data centers and actually start running them. And if that's the case, then the investment picture in the US gets even worse than it is just now. And I think that's why we're looking at a downturn in the US economy. That, joined by figures and signals from the housing market and indeed from the interest rate yield curve, are all suggesting to us that we're heading for a much weaker 2026 in terms of US GDP growth. And this year it will only be, on average, 2.2%. So you might be looking at less than half that next year.
So, Jim, it's a very big call that you're giving, in fact, projecting almost half the GDP in the next year as compared to this particular year in the US. What about some of the other big economies of the world? What's your view on that?
Yeah, I mean, this is actually as much as anything the IMF's forecasts that we don't particularly pay much attention to Europe. I obviously live in Scotland, so there's a wee bit more attention paid to the UK. But generally, I just look at the IMF numbers, and they're all looking at weaker 2026 growth than 2025. We do spend a lot of time on the Japanese economy. And there, the projections are that instead of 1.2% growth, which is for this year, which isn't particularly strong to begin with, next year is going to be closer to 0.6%. And I think that's if Japan's lucky. It's quite possible that it'll be below even that level. The UK, if anything, is probably headed for recession as well. So, I mean, across the advanced economies, things are actually pretty dire. The emerging markets look better. Certainly all of our numbers are positive for them in terms of the outlook for 2026. But you've still got that drag coming for the big exporters because of what's happening in the advanced economies.
So, bleak picture when it comes to the advanced economies like the US is what you're projecting for 2026. And you said emerging markets will do much better. What about the Indian economy? How is that expected to fare?
Yeah, well, we haven't really done a 2026 GDP number yet, but for fiscal year 2026 fiscal year, which of course finishes in March, we're looking at 7.8% for India. Depending on what policies are put in place by the government for next year, I actually think that 2026 will be stronger than 7.8%. But that's going to be down to moves to try and make doing business easier in India. It's all about really getting the domestic economy back up and running in a very significant way. There's nothing much that the government can do in terms of investment spending. It's already done that, and it's done a very good job there. Or the central bank can do in terms of interest rates. Interest rates are at an appropriate level in India at the moment. They're not too high. It's certainly encouraging of investment spending. But it's now all down to doing business. The labour law code changes have been a very positive move. The GST changes this year have been a very positive move. Next year, what we're really looking for is changes to the Factories Acts that will allow companies to grow much more quickly in India going forward. And it's got to be a domestic story because like every other emerging market just now, if India was relying on the external sector, it would be slowing down next year. So the domestic economy is absolutely critical in that respect, and government policy to try and ease the costs of doing business are going to be right at the centre of that story.
Right. So your views are pretty positive on India's growth, and of course, a lot of domestic-driven factors are going to give a stronger GDP for India. But what about the entire tariff war that disrupted the global economies in the year gone by, Jim? How much of a significance will you put to the tariff war for disruption and also upcoming slowdown?
No, absolutely one of the reasons for the slower growth. Disruption and uncertainty, because uncertainty is created by disruption, are the absolute killers for investment spending. People just wait and see. And this has been happening during the course of 2025 as well, just right at the start because of all the tantrums around about tariffs. A lot of companies just stopped their investment spending. Now, of course, that wasn't true in the hyperscaler space and the technology companies, and we've seen actually very good export numbers this year from technology companies because that boom has been well and truly in place. But it's very narrow. When you get to real economy industries, old economy industries, there's been much less in the way of investment spending and much more concern about from companies about the future just because of that tariff uncertainty. And I think that's really going to start to become much more evident during the course of 2026 than it has been in 2025. The technology side as well, as I say, I think it becomes a lot more constrained going into next year. There's been huge, if you like, brought forward expenditure in 2025. That's going to start evening out from here on. So, yeah, right across the board, I think the uncertainty that's been created is going to be a drag on investment spending.
So, Jim, very, very alarming projections and estimates of the tariff disruption also, which is going to have a huge and much deeper impact in the coming year is what you're saying. How grave is this problem going to be? How long can it really sustain? And what are the solutions you think you suggest on policy, monetary front to really avert this situation?
Yeah, this is a very tricky one to assess, Nisha, because you mentioned one thing earlier, and I think it was an important point to be making, and that's that the debt levels, and specifically government debt levels in the advanced economies, are causing markets a lot of concern. Obviously, the financing of that debt and just where interest rates will go is critical in terms of the assessment of the bond markets as to whether or not they should remain calm. Well, of course, these are very high debt levels in all of the advanced economies. In the US, government debt to GDP is well over 100%. In the UK, it's over 100%. In Japan, it's over 200%. This is something that is beginning to unsettle, I think, bond markets really rather significantly, because what we've seen over the course of this year, for example, in the UK, from August 2024 until now, there have been 6 interest rate cuts. It's around about 150 basis points worth of interest rate cuts. And the 10-year bond yield has gone up over the same course of time. In Japan, where interest rates are very, very slowly moving up, at the official level, they're moving up far, far faster in the bond markets. And in the US, where again there have been interest rate cuts over the course of this last year, the 10-year bond has basically stayed exactly the same. Yeah. So these are all signals that are saying, look, we're worried about the debt levels, we're worried about the inflation levels, and even if you cut interest rates in an attempt to boost economic growth, at the official level, the bond markets might not be taking that on board. And if that's the case, then any downturn in the economy takes a lot longer to play out than would normally be the case if interest rate cuts were being made across the board and bond markets were accepting those interest rate cuts and cutting bond yields as well. So what it's really saying here, I think, is that 2026 could be a very bad year. The dollar could fall significantly further from the levels that it's at just now. And it's going to be a story of which countries can stimulate domestic demand best to try and offset the weakness in the global external demand sector. And I think both India and China have a very good possibility of improving their domestic stories and then helping everywhere else in the emerging markets that are selling into those countries.
Right, very significant insights given by you, Jim Walker, when it comes to slower growth of larger economies like the US, almost halving the GDP, and also the various disruptions, while India stands tall along with China and more centered around the domestic growth. And dollar significantly to also come down is one important aspect that you mentioned. Thanks so much, Jim Walker, for all those important insights for the upcoming year. Thanks so much for joining us on NDTV Profit.